My next guest says the fear in March was just the first warning. He is Mike DiBiase. He is the editor in chief of the Stansberry Credit Opportunities publication. Thanks for coming in, Mike.
Thanks for having me, Jessica.
So, Mike, you say the Fed's actions are just extending the day of reckoning. When should we expect that day of reckoning, and will it be worse because it has been delayed?
Well, absolutely, it will be worse because it's been delayed. You're right. What the Fed has done is they've stepped in and temporarily restored confidence in the credit markets, and that's given a boost to the economy, given a boost to the stock market. But really, the day of reckoning is just, it's just extended and moved that day forward. Corporate debt is at an all-time high. It's the most burdensome it's ever been. And that debt hasn't gone away. That debt has only grown since the crisis. And so that day of reckoning is around the corner.
Now, recently, Fed Governor Eric Rosengren said that the debt companies took on after the last recession is actually slowing our recovery in this one. How do you see it?
Well, I see it the exact same way, Jessica. Corporate debt was around $6 trillion at the end of the last recession, and it only came down about 9% during the recession. So it really wasn't wiped away that you'd want it to in a credit crisis. Since then, it's grown to $11 trillion today. So it's almost doubled since then. And do you think corporate profits have doubled since the last recession, or GDP? No, it hasn't.
Mike, Standard & Poor's predicts a 12.5% default rate. How does that impact what you work on and the types of strategies you employ in the credit markets?
Well, it's very important. So first, I want people to understand what that means. The default rate is the number of companies that are expected to default on their debt over the next year. So what Standard & Poor's, one of the major credit rating agencies is saying is that over the next year, 12.5% of all companies are going to default on their debt. Okay. For over the last several years, really pretty much since the last financial crisis, that percentage was around 3%, 2 to 4%. It's since grown this year since the pandemic from around 3% to 6%. So we're around 6% today. S&P is saying it's going to grow to 12.5% over the next year. And that's actually their base case scenario. They actually have a pessimistic scenario, which I think is actually going to be closer to the reality, which is 15.5%. So think about that. 15.5% of all companies today are going to default over the next year. That's a big number of companies. That's over 300 companies.
Yeah, 300 companies. And the art of what you do in credit opportunities is really finding the companies that get pulled, the good companies that get pulled down with the ones that actually will default. How much more target rich is the environment about to become for you?
Well, a lot, Jessica, and that's really where the opportunity is. And that's exactly right. So what happens is when the default rate skyrockets like it's about to do, investors start getting scared, right? Anytime that rate goes over 10% historically, what we see is that the high yield credit spread, which is the difference between the rate that you would earn on like a US Treasury bond and the rate that you would earn on corporate bonds, that spread grows and widens. So what happens is investors get scared. They're all of a sudden worried that they're not going to get paid back as they should be, and they just start selling all their corporate bonds. Now, some of these bonds they should be selling because they are, like I said, a lot of these companies are going to default and never repay that debt. So we're going to see a huge default cycle and credit crisis. But the good news for investors is that what happens is a lot of good companies' bonds get sold as well. Investors just dump all their bonds and assume that they're not safe. I mean, I'm really talking about high yield bonds, not investment grade bonds. So not the best of the best, not the super, high credit scores. If you think about it in terms of consumer debt, we're talking about the more risky companies. But there's a lot of good companies who are capable of repaying their debt in that pool of high yield debt. And those are the ones that myself and my co-editor, Bill McGilton, search for. And what happens is when investors sell off those bonds, they can start trading for huge discounts to par value. And par value, a bond typically trades for $1,000. So you invest in a bond, you're going to get paid some years down the road at maturity, $1,000, right? But those bonds trade like, stocks in the open market, and they can trade for far less than par value. Now, if you think you're going to get repaid, they're going to trade at par value. But when investors start to worry, $1,000 bond can start trading for $600 or $500 or even less, $300. And in times of fear, that's when they tend to trade, far, far below par value. And if you can buy a bond for $400 that you know you're going to get paid. You're going to get paid. You're legally entitled to get paid $1,000 at maturity. So that's a huge return you can earn on a very safe corporate bond investment. But the key is knowing which ones are safe and which ones are going to default and go bankrupt. And that's where we come in, Bill and I, and we analyze bonds. We analyze all the bond documents, financial statements, and we determine which ones we think investors should be buying, which ones they should just let go in the garbage bin.
So, Mike, where do people find more of your work if they want to learn more?
Well, they can go to stansberryresearch.com. You'll see all of our newsletters there. We're the only bond newsletter across Stansberry Research, and we're talking about corporate bonds here, not government bonds. And what our strategy is to let investors earn not only income from the bonds, the interest income, but to also earn the huge capital gains, stock-like capital gains with these bonds as well. So it's a really unique strategy that you don't see in many newsletters. You certainly won't hear your broker pitching this idea to you or Wall Street pitching this idea to you, because they like to keep those profits for themselves. But when you look at the world's wealthiest investors, billionaires, like Warren Buffett, those guys use this strategy and they employ it exactly when a moment like this arrives in times of a credit crisis. So we're getting ready to enter a fairly rare occasion. These types of credit crises only happen, every decade or so. So this is a unique opportunity for investors. We're about to enter another credit crisis, and you can earn safe equity-like returns where you're legally entitled to be repaid all of your interest and all of your principal at maturity. And so I think it's a great time for new investors to join us and hop on board. And like I said, the key is knowing which bonds are safe. And that's where Bill and I come in, and we do all the work for you.
All right, a way to clean up when the market is looking down. Thanks so much, Mike DiBiase of Credit Opportunities. Thanks for coming in.
Sure, Jessica. Thanks for having me.
And if you'd like to catch up with more Stansberry Research content, please check these social media channels and find us. That's all for now. Thanks for watching. I'm Jessica Stone.